say?
Yeah.
Regarding angel investors, I believe that they want to diversify their risks. So in case if they invest in different companies in different, probably even fields, they will be able to distribute their risks. And in case if your company goes well, they will be happy. But in case if not, they will have already another company where they also have the investment. Regarding friends, this is obvious because they like you and they want to help you. So probably if you succeed, then they will succeed as well. They will be happy to help you. And
I think it's valid points that you make. Yes. Any other opinions?
From my end, I would say that investors invest in companies because they would like to have more money at the end of the day. So that's why it's called investment.
Yeah, agreed. So with investors, indeed, like the name says it all, and we have to keep this in mind. Investors are there to make more money. Now, how do investors make more money? How do they get money? This is very important to understand.
They can become shareholders that they will take some portion from our profits, so they will make money in this way.
Yes, that is a more traditional way, let's say, of making money, because I think let's see, you have two ways of doing money when investing in a company. One way is to get shares from the revenue, so from the profit. But then if you invest, let's say, 20 million, you will most likely get them back in, let's say, 10 years. Depends on the return rate of the business model. But basically, if you invest with the expectation to get your money back from the profit, you'll get it, let's say, in 10 years. But what's a bit different in the past, I don't know, maybe 20 years, but maybe even less, is that investors sometimes look at the growth potential of a company, and they want to have a faster return, which means that they invest today and they want to sell the shares to somebody else who is willing to invest later on after the company has grown. So especially people like the angel investors, they kind of speculate because they will invest in a variety of startups and they will make a gamble on your potential to grow. The early stage venture capital, again, they will gamble on your potential to grow, but then we also have to understand that there's a high risk at this point in the investment chain, because at least 9 out of 10 startups don't grow to the level of expectation of the angels or of the early stage venture capital, which means that they don't get in 2-3 years to the level that the investors have expected. That also means that they won't get that much money as expected back, which might lead to discussions, to conflicts, to misalignment, let's say. Later on, the venture capital that are following up usually have the same expectation. The investors which have more long-term expectations usually are in the private equity side or on the IPO side, so the last two slices, let's say. But everyone else, from the angels to the venture capital in the middle, they have expectations of gaining money from the growth. So when they will look at a company, they will want to see the potential of growth before the potential of profit. This also means that they will have the expectation of all the money to be invested in growth, and they will want to be involved and have a word on how the company will be run to make sure that the growth is there. you also have to know that that this kind of funds, like the early stage venture capital funds and the venture capital funds, they usually have a fixed time frame of existence. So usually they have something like 7 years, because they are set up, and during 7 years they invest, and then all the money is given out, and they expect returns from that money. And then usually they create a new fund. So like the way it's organized, there's a management team, and they create funds. They create a fund of, let's say, 100 million. They spend the money, then they create a new fund with 100 million. They spend the money by investing it, and then they manage the investment, which means, how do they manage the investment? What's their mean of discussing with you guys? Katalin, maybe you can tell us from your experience. How are the investors present in, or how they can influence what you're doing?
Honestly, I know that they have some type of ownership in the company, and with all of the big business decision making processes, they have to be involved, and it has to be discussed with them, because of course it's their money. And when we made the agreement with them at the beginning, we had to be crystal clear on how we would like to spend their money. So it's not about they giving us the money and then we decide, but first we had to agree on like what the scope, and there's a plan, and we have to be very strict with following up with that plan. And if anything changes, they have to be involved and informed, and it should be discussed with them.
Yes. So the way this is organized, and we will see it in the next slide, basically they have one or more seats on the board. So basically all the decisions in a startup are taken, the strategic decisions, the resource related decisions are taken in a board, in an executive or board of directors, whatever. And the investor has to be present there. And the way that decisions are taking on the resources, on the investment money and so on, that is all written in a document which is called term sheet. And we will discuss, one of the last slides will be about the term sheets, so that you understand how these things are structured. Basically, the term sheet is the document that defines how money will be spent, what the, let's say, rules of engagement will be after the investment, how long the investor will be in the company, how he will exit, to whom he can sell, at what price maybe the shares can be bought back by the initial founders, and so on. So these things go into the term sheet. Now, if we go back to the friends, family, fools, and founders, what are the expectations of these people? And how strict are they? From your experience of lending money or being lent money? From common sense, I mean, if
I think,
yeah, please.
I think it is, they just want to multiply their money in a period of time, yeah. And then this is based on the trust relationship.
Yeah, I think, the basic expectation is that you pay the money back. From how I know my family and my friends, they will say, oh, listen, I lend you money. If you give it to me in 2 years, we're good. They will not want to get a profit maybe if they lend it. And if they invest, if you lose it, the expectation will be somehow to give it back, maybe. Maybe that's the maximum. And maybe if it's family, it's like, okay, forget the money. It's good that you're not in jail because of bankruptcy or something, That really depends, But basically, they don't have a very strict expectation. And many times it's not written down very strict. So you don't have a very strict contract where you write terms, where you say, you give me that much money, I give you that much shares, and in 3 years this happens, and if it doesn't happen, we do this. So you don't have this. While with the investors, you have it. And it's important to have it, and investors will ask for it, but it's important not just for the investors, but it's important for you guys. because it's important to have clarity on how money is used, on how decisions are taken, because then you can avoid conflict, you can avoid misunderstanding, and you can avoid any situation which will be damaging for the business. And damaging for the business means damaging for you as a founder, as an entrepreneur. And it can be damaging for the long term, because it can maybe give you a bad name as an entrepreneur, as a founder, because then maybe the investors will go around and say, oh, I invested in this startup and they just ate my money, they didn't do anything. So basically no other investors will want to support you. So it's important to have clarity, because if it's written down, it's like, hey, listen, guy, like it was written here, we did what we agreed. So you cannot go around saying this kind of things. So just keep it in mind and just write it down. Now we go again a bit back to the development grants and to the research grants. So what does the state expect from a startup that it grants money to? Maybe also you can tell us what you think the expectation of the Turkish state is from helping you, and then like anyone else who has an opinion can share.
In Turkey, in the University Incubation Center, they don't have any expectations. Even I lose everything, and even if I am not successful, because it is under the university funding, and they are just using this opportunity that is provided by the regulations. So they are the one of the tools that regulations provide, and they are just helping the student like me as an to promote entrepreneurship as in the incubation center. Even if I lose everything, I have nothing to do back. I just close it and the agreement is over, and at the time of the day, and that's it.
Okay, but why do you think the state is doing this?
Because they want to create, they want to promote the entrepreneurship in the ecosystem. They want more entrepreneurs to develop the economy.
Okay, yeah. So indeed, they want more entrepreneurs. So how can we measure their expectation? Is it number of new companies? Is it number of jobs? How can we measure it?
Okay, of course, I have some, I need to do some regulatory progress, because I wrote the project and I gave them a timeline in the project, and the committee of referees approved to accept me in the University Incubation Center. So I am responsible to University Incubation Center to succeed and to follow up my project. Of course, this is, and there are some promotions, like if I get IT team member, there is some regulatory tax discount that I don't pay comparing to, so we create also the human resources support in the economy. So this is another part. So I give them job and they work. This is also under the agreement. Another point.
Yeah, you know what FOMO means? Fear of missing out. To a large extent, I think that states, European Union, US government, Israeli state, sometimes Turkish state, they are supporting startups and innovators out of the fear of missing out. Why? Because especially in Europe has fallen behind the United States and China in terms of entrepreneurship, large technology companies, innovations. So basically, they want more of that in Europe. In many other countries like Turkey, where again there is a certain economic development way of thinking, there's a fear of missing out. They look at the economy and they say, oh, what do we have here? We have a lot of companies in tourism. We have a lot of companies in manufacturing, but we are at a very low point down the value chain, especially in manufacturing. So we don't have enough innovators, companies that scale up really fast, that become unicorns with a valuation of $1 billion. So we need to have that. So how do we do this? Well, we support 100,000 startups. We especially support them in like technology or areas where there's a large chance, statistically, most likely, or out of any other calculation, that a unicorn or a high innovator comes out of, and then we do our best. Like we put money into that, we give tax incentives, we create incubators, and we maybe create a support mechanism in the law, and then we wait and we see what happens. Now, the interesting thing that happens is that most of the states think very much the same, and they also copy the instruments one from the other. Like we copied from the Israeli state in the European Union. To some extent, I think the Turkish government is, again, copy-pasting some of the things that have been successful. But when you have the same mechanism all over the place, sometimes entrepreneurs who are very entrepreneurial beings, so they're flexible, sometimes they go away. They don't stay in a place where maybe they don't have enough support. And that's something that happens in Romania a lot. We have a lot of entrepreneurs who have moved out. And for example, we have a Romanian unicorn, but its headquarters are in New York. Because, why? Because in Romania, it was impossible for them to take investors, because an investor that would invest in a unicorn wouldn't do it in the Romanian legal system, which is very unpredictable. And they wouldn't do it in a European legal system, which is very bureaucratic. They said, listen, if you guys want us to invest hundreds of millions of dollars in it, you have to move to the US. So they moved to New York, they got invested, and now they're worth, I think, $16 billion. But everyone works out of Romania, just their headquarters is somewhere in downtown New York, and they have 100 people there, that's it. But this is also something which complicates maybe the long-term development. But I think most of you are far away from the $1 billion valuation today. Once you get there, you'll think about how you do it. And also your government will think about how they keep you in the country, they don't let you go. But again, this is the different kind of expectations. And you see that like the government has a very long-term expectation. The family has a friendly expectation, and it's maybe not long-term, but it's like short-term that you give the money back. Then the investors are more pragmatic, and they want it in a foreseeable timeline, and they want to have an exact estimate of what that growth is, what that return is, and how it will be achieved. So these are, in a nutshell, and on one slide, the various types of getting invested in. Now, we touched a bit already on the grants, but just to, again, wrap it up in one slide, basically the grants you get done in your very early development stages. So when you establish a company, especially in Europe, but I think it's happening also in some places in Asia and in the US, you can get a grant to establish a company. So basically, if you are in a certain sector, if you do something very specific that the states want to support, they will give you money also to open the company. And later on, they will also give you money to grow the company. So you can get a grant to open a company, to develop a prototype, to hire the first people, to pay for the salaries. So the first development stages. The state giving you a grant will not ask for a share of your equity, which means for a share of the company. That's why it's called non-dilutive. Dilutive means that they don't dilute you as a shareholder. So you can still be the only shareholder, or together with your partners, you can keep your shares. When you go to equity, it is dilutive, because if those people come and they put money in the business, so they want maybe 10% or 20% or 50%, so then everyone else's shares, they shrink proportionally. The state is also kind of risk tolerant, because it just wants you to be aware and cover some legal risks. So to have a company, to do everything according to law, so these kind of things. But then again, it doesn't ask you if you close the business later on, and also mentioned that he doesn't have this kind of strict things on his head. But then what speaks against grants is that usually you don't have them every day. Like usually there's a calendar, and in many countries you can get them like once every 3 years. So if you're not lucky to be starting a business once every 3 years, or at that exact time, you're out of luck and you don't get a grant. What also happens is that you get a lot of reporting to do. You need to submit reports, technical, financial. So you will spend some of your startup time doing this instead of doing products and sales. So be aware that if you take a grant, you need to take like 10 to 20% of your time and just do reporting. So that's a con, and that can be quite annoying. Now, equity comes a bit later. So no equity will come in a company from day one, because you need to at least make, a PowerPoint, a presentation, have a few clients who agree that you have a good product and maybe buy it, or at least provide a letter of interest or whatever. And only then will you get invested in. So you will get it from the second stage and maybe up to the latest stage of development. You don't have to pay interest for the investment unless you agree for a scenario where you turn the investment, so the equity investment, into a loan later on. This can also happen, but let's call it rare. The expectations are a bit more long-term, which is usually 3 to 7 years for the earlier stage investment, and then 5 to 10 years for the later stage investment. There's an expectation of liquidity, which means that you need basically to come up with a profit. So within this time frame of the investor being there, you need to become profitable. Unless you become profitable, at one point the investor will want to change you as a CEO or impose some changes in there. Now, if we think about how startups work, there's one interesting example that we can think about in relationship with investors, which is Facebook. Basically, Facebook came up with the platform and then found investors. And what they did is they kept getting invested in without being diluted too much, until they were able to have a critical mass of users before coming up with paid services. So they didn't make any kind of revenues for many years. The way they were able to do this was by having investors on board. The invested money was paying for the expenses, for the salaries, for everything. And they afforded, by the invested money, they afforded to maybe kill all their competitors or buy them out, so as to become the sole or the main social media platform. and they managed to integrate also with WhatsApp and Instagram in their ecosystem by buying them. But they afforded to do this once they started selling services. So this is a way of like juggling with investment versus revenue. But most of the investors, they have the expectation that you start getting revenue as fast as possible. Of course, everyone these days wants to do a platform, and everyone wants to become the leading platform before they start getting paid and just follow the Facebook model. But it doesn't always work out, and every business needs its own business model. You cannot copy paste what somebody else has been doing. Of course, there is also the debt, so getting a loan, and this is the most likely, the most frequent way to get funded. This doesn't come in the very early stages because the banks are not very friendly with risk. They don't want your shares, but they want an interest. And what's difficult with debts, with loans, is usually they also want you to have a warranty, like a building or any kind of asset, which they can use as a warranty to give you the loan. So this is not achievable for many startups in the beginning. And I just wanted to use this scheme here with the debt so that we understand why the loans are not that friendly with startups, at least in most countries. It can be a bit different in one country or the other if the national government, through maybe a public bank, wants to support startups, and then it gives out loans with it's called usually a subsidized warranty. So the state takes the warranty over and provides a loan with no expectations that you warranty with your own assets, which is nice. But the difference is that you have to pay it back. So it's not like a grant. Any questions related to these things here and the difference between these? Anyone here work with the loans for the company he's running? No? Okay. I did all three. I took loans, I took investors, I took grants. I know the positives and the cons of each one of these. If you have any special interest, just let me know.
I can ask.
Please.
While having these funds, should we always give the management of the project or the company, or the stick to which direction the company or the project will go? Should we give always to the funding investor, or how the things works on this stage? Because it's very critical. Because if we decide and the founder, the investor doesn't accept, and there should be the conflict to grow up. If we see of course, it depends on our ability to manage this process, but generally how it works, I want to ask.
Okay, I moved to this slide here because it maybe helps with answering this. So it's also important, like we spoke about why these people support you financially: the government, the friends and fools, the investors. So we understand why they do what they do. But then we need to also go and ask ourselves, why would they invest in your business and not in somebody else's business? And just to give an example about how venture capital firms and investment funds usually work, they receive every year 1,000 requests for investment, and they invest in 10. So that's like, at least in Europe, that's the proportion of a good investment fund. So unless they have 1,000 proposals a year, they're not in the market. And unless they keep the portion of 10 out of 1,000, they're not selective enough. So they don't do a good job, let's say, in selecting. So these are the kind of like principles, let's say, of this industry. But then again, question is, why the 10 out of the 1,000? Why not any of the other 990? And this is important to discuss and understand. And it replies kind of to your question. So there's a number of things that the investors will be looking at, and you find them here in the elements of evaluation. This is about the business model and the valuation, the way that an investor is estimating the value of an investment and of the company. So one reason is the business opportunity. So what's the business model? Is there a market there? And if there's a market, is the market going to grow, or can the startup take more of an existing market? Is it a niche? Is it a segment? What is it? But basically, they will want to look into this. When you approach them for an investment, you will have to be able to explain this to them. But then if they're good, they will check. So they will go and they will do their own checks to see if what you said is correct. One way to do this is to look at what your competitors are doing, and to see who the market leaders are, or who's close to what you're doing, and how they are running their business, and who has invested in there. So these guys, they really do very thorough documentation. So you need to do it yourself as well. You need to know who else is in this market, how much money they're making. If they're doing something else than you are because you have a new business model, let's say, still it's important to understand in related markets or in related business model how much money is being made, so that the investor understands where you can be together in a number of years. Again, this also means that they have to understand the market. So they understand the size of the market, then they have to understand if it's fragmented. What means fragmented? So if we look at the United States and we look at the European Union, they're markets of similar size. But the European Union is a fragmented market because in each country there's a different language. So for example, if you're selling a service which is language or cultural sensitive, you will need not only, and I mentioned also regulation there, you will need not only a lawyer for each country with understanding of the legal system there, but then you will need to translate it and have it adapted maybe. So that will be extra expenses. So that increases the cost. So basically, maybe you can go to the US because you have a smaller cost, like most likely like 10% smaller cost, which translates to profit. So you can do the same business in the US. Like many times we have startups which say, oh, we can do this in Europe because there's a successful startup in the US, but it's not on our market. The problem is it's much easier for the US startup to grow in one legal system, one cultural system, one market, instead of a replica growing in like European Union, you know. But then the next thing that they will be looking at is the team. So one reason to invest or not to invest is, how does the team look like? Who's the founder? Is it somebody who has experience with the market? Is he a good manager? Is he somebody who can lead this company to growth? Because if not, they might not invest, or they will invest, but they will say, listen, we invest, we put €1 million in this, $1 million. But we will need to hire CEO, and you're very technical, you're very good with what you're doing, you will have to step down and become chief technology officer or chairman of the board or whatever. But take your hands off the executive part because you're not good with it. So when they invest, a serious investor will discuss this, and he will have expectation on this side. So basically, it's many times it's not enough to have a brilliant idea unless you are a guy who can actually make it happen. So when an investor comes, he will have the expectation either for you to run it or to come to a common agreement that you hire somebody who runs it. If you cannot run it, to growth, but if you know technically how it happens. I have an interesting example from a startup that I'm working with. It's doing a document management system. And the technology has been developed by a guy who is technically very gifted. But in terms of management, he is completely catastrophic. So 2 investors came in, and because he was so bad with managing the business, they couldn't invest in the company he had because there was a chaos in accounting, let's say. So because of this, they agreed that they set up a new company, throw away the old one. And he only received 1/3 of the company because they couldn't even keep the old company. They just had to get him over to the new one, have him redevelop the technology. But nothing could be used from what was in the old company, contract, nothing. So instead of him maybe maintaining a majority shareholdership, he had to go down and have then obviously one of the new investors, he put a CEO, the other one put money in, and then he's doing the technical part. But it's still good business for him. It's still, I mean, much better than what he was doing on his own. So these are the kind of, maybe one example of situation that can happen. So I'd like to maybe go back to the slide because you provoked me with your question. So the team is one reason for investing or one reason for not investing. And again, you have to be a bit clear about the team to the people that you address as investors and say, listen, this is us. Like, we're 3 people. We know how to do this and this and this. And we've achieved everything we have done until now with these 3 people. And then in the process of a negotiation, they might ask for changes, for different things, and you have to see if it fits you. This will come up. I was muted somehow. Did you guys hear me?
Yes, clearly.
Okay. I think somebody muted me, maybe of the mistake. Okay, and then since we're here again, an investor will come in depending on what you propose to him in terms of shares. Like, if you tell him, listen, you invest $1 million and I give you 5%, well, if you're early stage, if you haven't made $1 million turnover, they might say, oh, listen, no, this is like disproportionate, no. But if you propose him a decent share, he might join. And then it's also important to discuss the exit strategy. And in terms of exit strategy, it's not just about the value, but the question is, if a new investor comes on board in a couple of years and offers us a price of, let's say, I don't know, $20 per share, who exits first? Like, does the investor, the angel investor, exit first, take his money back, and then the founders? How do these things happen? Like, if you sell 10% of your company to an angel investor, which is a decent amount, like 5% is the normal maybe percentage that you would sell to initial business angels, but you can go for 10%. But then if later on you have the expectation, of course, for an investment fund to come in, what happens? If he wants 10%, is it the 10% that the angel investors had? Are those the 10% that the fund will get, or is it other 10%? And will the investor stay on board for the next round? And if these are the shares he gets, and at the same time the fund will want to invest into the company because the company will need money, what's the amount of money that the angel investor gets before money being poured in the company? These things have to be clarified. They have to be written down, they have to be discussed, because those are reasons for these people to invest. And I jumped a couple of slides to come to this one here and discuss, and I'd like to go back, but and again take some questions if you have any questions related to this here, and we'll come back to the other slide.
And thank you very much. Very detailed explanation.
You're welcome. No more questions, then we go one more slide down. So, sorry, I pushed too many buttons at the same time. We mentioned in a couple of slides ago that venture capital is the one that usually comes after the business angels, the angel investors, and is the one that is expecting you to grow so that they can get a return from the growth. It's also important to understand that private equity, which is a bit different, which expects usually long-term return, and these two types of investment usually look at different companies as well, and I wanted to address this as well. Private equity usually looks at companies which maybe are older, are mature, have a predictable business model and a predictable growth, even if it is small. And usually they come into these companies to finance either growth. So for example, if you have a company which is producing pipes for gas, let's say, that's again a Romanian example. We have some companies doing pipes for gas, but there's new projects to put gas in other villages and cities which don't have gas. Obviously, there will be a market in there. So maybe a company which is already producing this, which is very mature, which has 300 employees, but has not that big a profit margin, let's say, in the overall turnover, because it's already flattened out as a market and as prices. It wants to grow capacity to be able to produce more. So it can go towards a private equity fund, get funded to build a new factory, and sell a percentage of the shares, which means it will share the profit from the existing business with the future profit from the new capacity. And if this is a win-win for both the existing shareholders and the private equity investor, it will happen. While in the case of the venture capital, they will look for young companies, somebody who's 10 years old and hasn't grown to become a unicorn. We don't expect it to grow in the future, do we? But somebody who's new, where you see numbers growing, where you see an interesting product, where you see young people going around with potential, you invest in that. You can invest in that as a venture capital. So these are a bit different in the way they go by their business. And if you meet people from private equity, it might be that they will not be the ones to invest in your startup, but rather people from the venture capital. And summarizing what an investor is doing, and this also refers to what we discussed a bit with Ozeb, they do three things. They invest, they develop, and they exit. In order for them to invest, they won't expect you to knock on their door. They will look for you. I mean, a good investor, a good venture capital firm is looking for deals around them, because you don't always find them in front of your office. Sometimes you gotta dig really deep for the good ones. There's some smart people working in some research institutes in some universities that have interesting products, but they don't know how to get invested in. So as a venture capital, you have to look for these guys as well. They usually have a plan, a year-by-year plan, which most likely is made for 5 to 7 years, on how they want to invest the money they have raised. It's important to understand that usually the money that they manage is not their own money. So they will not take decisions as the angel investors, a bit more subjective, but they will, because they have to be liable to their investors. Every investment fund has investors, which are individuals or companies. So they will have to respond to these people who have put money in there. So they will have to look at any investment and be able to write down the reasons why they chose one and not the other. They cannot say, the wind blew this way, so I did this. It doesn't go like that. They have to have reasons. They have to be able to write the reasoning why they invested in something and why they didn't invest in something else, and they will do this. Now, once they are on board, they will want to support the development of the company. I mentioned that they have a seat on the board. So they have a person who represents them, who is either an employee of theirs or is somebody that they know and they respect and they want to work with, that knows the type of business and the sector. And there's many people which are maybe, say, like specialized in being part of boards, because they are trusted by the venture capital firms and they have the experience. And many times people will be proposed who come from the sector or who have executive experience, and they're sent there to see how you take decisions, if you respect what's in the term sheet, but also to support you, to provide advice, to discuss challenges, to help you with business development, with deals, with maybe templates or procedures and things like this. Also, they are there to. Oh, thank you, Bahar. I will wrap it up in a couple of minutes. Thanks. So they will also be there to support you with any kind of decision that you need to take for which you are not prepared. So they're a valuable asset. Now, the last thing that the investor will do in relationship with your company is exit. So they want to exit there by making a profit. So you have to respect this and know that they have this expectation. Now, I understand that we're getting to the end of the session, or at least my session. So I can provide you with these slides, and some of them have a lot of text on them, so you can read it and understand what they refer to. I just want to pinpoint a couple of things. This is an interesting thing, which you might like and might use. It's a way to allocate shares with your founders or with investors. And you can actually find this online somewhere. I can look for it and send it to you guys as an Excel. What's interesting is basically you can use these 5 ways, and this usually comes up as a question. How do we divide shares between founders? And this is important to clarify and discuss this kind of reasoning, because it will be something that you might then discuss also with the investors. So it's criteria like who has the idea, who's doing the business plan, who is CEO. But then there's criteria like technology, business development, marketing, team recruiting. And basically you can use this just to put percentages of the shares that you want to give, and then you can make an average and decide how you divide between 2, 3, 4, founders. And this is usually things where people might be in disagreement, and this helps. And last, I think this is the last slide now. Yeah, this is the last slide. So we mentioned the term sheet. The term sheet is something that is signed by the startup and the investor before the investment is done. And here you can find what's usually in a term sheet. If you Google term sheet, you will also find a number of examples. And I think it's important for you at one point or the other just to look at some of these examples so that you are aware of how these documents should be drafted. Of course, when you enter into such a discussion, you should get a lawyer. You should get somebody to support you who knows how to draft these things. And always keep in mind that it's a negotiation. So you need to negotiate with your investors. And don't always accept the first terms which are on the table. Make up your own scenario of what you want and what you need, and then discuss it with the investors and try to find a midway, let's say. So keep this in mind. I will send the slides to Bahar, and maybe then she can share them with you. And you'll find some interesting ideas here as well, which you can Google for more details or just email me, and I'll be around. Thanks, guys. Enjoy.
Thank you very much, Jonas, for your relevant sharings. And he told about how to approach funding and investment. And if Anna is here, and she will gonna tell about how to pitch in front of the investors. It's very interesting topic for us. In first training, we learned about how to approach funding and investment, and now we will learn, if Anna is here, how to pitch in front of the investors. Anna, are you here?
Yes, good morning, guys. Yes, good morning. Happy to hear you. I'm here almost, almost 17 minutes as we discussed. Okay, it's not about this. So good morning to everyone. I ask you guys, please, I will be happy to see your faces. I don't know in which time zone you are right now.
If people, can you open your cameras?
Yes.
Anna request us to open it and show your face.
Okay, I see a few faces right now. It's great. Let me change this gallery. Oh, much better. Even some familiar faces here. So good morning, everyone, guys. I don't know where are you. Probably I have to say you good day or good evening. So I'm happy to see you. My name is Anna. I'm CEO and founder of Happy Farm Business Accelerator. I work with the startups more than 12 years, and I've been in your shoes. Lots of times I raised money. I calculated this morning, I already raised $3.2 million. And I know how it is. Usually I can say that it's a nightmare. You know, I'm always nervous. It's a stress. I scratch in my face. I'm so angry, and I hate this job, raise money. I always wish that someone else can do this, not me. And everyone asked me, oh, how are you? Is everything good? Of course I'm not good, because I have to think about this money, about this investment. I have to think how to find this investor. And it's always like no recipe, and it's not like a magic, you know, when you say and think, okay, God, please help me. Please, I need this investor so much because our team's struggling without money. Please, God, help me. And God don't listen to me, and I don't have this miracle. I don't have money. And I think, okay, what's wrong with this? So what I want to do today, I want to tell you how I usually raise money, give you my recipe, and it will be some kind of roadmap, what you have to do with your company, with your business to prepare yourself and then pitch investor. So step number one, you have to think about your goals and about your needs. It's important. Your goal, for example, you have to think not, I don't know, you start doing your business, your company, your MVP, your startup, and then in the middle of the, I don't know, all this process, you think, oh my God, I need money. And no, you have to plan this. You have to think, okay, right now my team and I, we are working on MVP and we need money, for example, on November or on next December or on January. So you have to think about your goal. How much money do you need? What is the amount of money? You need to 200K, 300K, or 500K. And what is the deadline? Because it's important. If you in general think, yes, we need money, but we exactly don't know when and where, and you don't know number, you have to think about this as a founder and as a CEO, and you have to think how much money do you need? Because if you say probably 200, probably 3, it's a different, it's a huge difference. You have to think, I need my money for my marketing, for my team, for my equipment, I don't know, for growth, for scaling. You have to have this structure in your head, and you have to imagine like why you need this money, how much, and where is the deadline. Because if you don't know, it always will be a problem. Step number 2. You have to think who is your ideal investor. You have to not be like a victim person. You have to be a leader in this process. You have to think, okay, I will be picky and I will choose my investor. So I have my list of criteria. So I created my list for myself, who will be like the best investor for me and for my company. I will share you my list. Number 1, for me, important that this investor, for example, work with this amount of money. I am looking for someone who will invest, for example, 500K in my startup, in my project. So people who invest usually 50K, 10,000, it's not my audience at all, because this guy doesn't work with this. Also, investors who invest 2, 10, 20 millions, also not my audience. So I focus on these guys who invest 2, 3, 500K. This is my guys. Second, for me, important that I can manage my company, I can be a leader, I can be a decision maker. So if I see that this investor can be like this person who called me in the middle of the night and say, hey, Anna, you know, I think for you and for your team important to do this and this and this. And this person micromanagement me and my team, I don't need this guy at all in my life, in my team, in my business life. So you have to think, what kind of investor do you need? Someone who manage your team, or someone who say, okay, this is money for you guys, I believe in you, let's go. Or as I said, someone who call you every day, every night, and it will be like nightmare, because some investors love micromanagement and I don't know, for me, it's like a nightmare. Next, it's about brand. For some companies, for some founders, it's important and essential raise the money from famous fund or famous accelerator as Y Combinator or 500 startups, or from Andreessen Horowitz. Probably it's a good approach to put this in your list of criteria. Or probably for you, it will be okay if it will be just like typical ordinary venture fund or angel investor, it's also okay. Just think about this. It's important for you, for your marketing, for your strategy or not. Next, what is important for me? For me, it's important networking. My investor has networking or not. My investor can help me or not with the networking. So for me, it's very important. It's number 1. But for someone, for some startups, for some companies, it doesn't important at all. So you have to think it's important for you or not. Next, it's experience in your industry. For example, someone say, oh, we send an email and our pitch deck to everyone. I usually don't do this. I choose investors who understand and work in this industry, who understand what's going on. Because for me, it's easy to explain what kind of idea do I have and what kind of product I build. If you try to explain something, I don't know, that you do like something revolutionary to person who doesn't have like any idea, don't have any clue, it will be complicated. So for me, it's important that my investor have this expertise. And also, next point, when we talk about this list of criteria, for me, important that my investor will be professional investor. So in other words, have experience. Some investors like new in this game, like amateurs. I don't work with these guys because they don't have experience. They like more vulnerable, then call you, send you emails like, oh my God, we invested this money. When we can see this money, probably it was a mistake. And you have to be like a therapist and work with this investor and make this investor like calm down. I don't have time for this. So for me, very important to work with a professional investor who understands what's going on, that this is startup. It's not like ordinary business. No, it's a startup. We can make pivot. We can have like lots of changes in our company and it's okay. Next point, it's a geography. Of course, if you plan work in American market, for example, and work with and launch product in the US market, and in the future also raise money from American funds, of course, it will be great that your investor, first investor or investors will be local. If someone, for example, you knock in the door, investors who lives, for example, in Asia or in Africa and say, oh, you know, we want to like grow in this American market, probably it's a mistake and you just waste your time and it means you waste your money. So think about this too. And last point in my list, it's a credibility and reputation. Of course, sometimes you need money and you think, oh my God, I need this money so much. And some guy without reputation or with bad reputation say, okay, this is money for you. And some people take this money. My advice, guys, don't take this money because today it will be not a problem. Today you will say, okay, it's great, I finally have my money. But in the future, it will be a huge problem because another investors would say, you have this person in your cap table. No, we don't have any association with these people. We don't need any links. Goodbye, and close this door forever. So think about reputation and credibility. Who are these people who invest money? Because it's easy to say yes and take this money, and then it will be a problem. Just think about this. So summarize this step number 2, just what I want to say, be picky, don't be a victim. So your work as a founder, as a startup leader, raise the money. This is your job. And investors has their own job, invest, and also find great ideas, cool founders, amazing team. So job and job. So don't be like, oh my God, I just waiting when investor choose me. No, choose your investor. And when you will have your list of criteria, believe me, it will be much easy for you understand. For these guys, I will spend my time. With these guys, I just waste my time because this is not my investor. It's not my target audience at all. And it means that you will not be disappointed. Step number 3, preparation. Why preparation is so important? Of course, you heard lots of story about your pitch deck, one pager, your email. I just want to repeat and explain what's going on right now. Right now, we don't have opportunities see this person, impress this person, do this like, I don't know, amazing pitch, and then talk. Right now, we're Zooming. We hate the Zoom. We have to be brief. We have to deliver information very fast because people see it and hear this presentation, boo, 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 boo. It's very difficult. What do you have to do right now? You have to prepare your one pager. Don't create 10, 15 slides presentation. No one look at this presentation at all. What you have to have your 2-3 slides about your problem, solution, market, and your audience, and of course about your experience. Because if you don't have any experience or your team don't have any experience, who won't invest? It's like, you know, guys, give us please like some money. Do you have experience? No, we don't have experience. Okay, why I have to give you my money if you don't have experience and you don't have any idea what you guys doing? So better create these slides with this information. Don't put a lot, because if investor want to know more, he asks questions. If you like at the beginning will give like so much information, these guys just close this presentation. Also think about your email, just one paragraph, very briefly. Problem, solution, market, audience, your team. Paragraph, boom. Investor open your email, read your email. Okay, understandable. I want to talk to this like founders, or I want to see this presentation. Open 2-3 slides. Okay, I love it. So let's schedule call. If you think that your product so unique and your idea so brilliant, this guy will read 15 slides, guys, no, it doesn't work like this at all. So think about this, and also think about numbers, because you don't need to send numbers immediately, but if you have conversation, you have to be prepared and explain what's going on, what is your business model. And also think about cap table. Cap table, it's very easy. I just saw previous speaker share this example, how this cap table look like. I will tell very briefly. For example, if investor asks you, okay, tell me about your cap table. You have to say, right now I have 80% of my company. My team have 20% of company. And we right now looking for investor. I'm ready sell 10% of my company from my portion for 200K. So, and this is it. Investor like sees that how this company structures, that 80% right now has founder, 20% have team. If you say, you know, right now I have as a founder 10%, and before I raised money, for example, 50,000 K, and sold my company like 90%, who won't invest in this company if founder has 10% and 90% has someone investor? Of course, like no one. So it's like game over, like, okay, just close this company and start at the beginning. So you have to explain very briefly about your legal structure. And of course, you have to rehearsal again and again. If you think that you can pitch investor like this immediately, be sparkling, be like super interesting and amazing, it doesn't work like this. You have to prepare. You have to take your phone, check with the timer, your presentation, I don't know, your speech, 1 minute, 10, 2 minutes, 3 minutes, it works or not. Because if you think that you can improvise, don't believe you cannot improvise. You have to prepare yourself, listen yourself and think, okay, this part, I love this part, it's a bullshit. Okay, I need to polish it and restructure it. So please do this. Step number 4, where to find investors. Of course, what I recommend to you guys, I recommend you, first of all, AngelList, because it's a platform with a professional investors from all over the world. Of course, most of them from the US, but these guys at least understand what's going on. And you can find group of investors, you can find venture funds, and you can find also angel investors. But back to step number 2, you need to have your list of criteria. You have to understand who is your investor. It will be easy for you when you know what you are looking for, what kind of people. It will be easy for you then like find these people in AngelList. Because in AngelList, how it works, lots of people, for example, who work in the big tech companies, different type of companies in Silicon Valley, Bay Area, and all over the world, they have money right now, they have tech experience, tech background, they understand what's going on. They say, okay, we already invest 5,000, 10, some of them 20, and they like organize some kind of groups, syndicates, and they invest in different type of startups. For them, easy to understand what is a startup. For them, easy to understand idea because they're from tech world. And it's not people, for example, who all these live, for example, sell some kind of, I don't know, sausages or bread, and you right now try to explain these people why it's important to invest in technology. No, this is professional people from tech industry. So it will be easy for you guys communicate with these people. Also, Crunchbase, different type of communities, different type of competition. Investors always in these different events. So you have to create this list. What type of events or, for example, competitions or communities match to your product, and try to find this investor there. Also, what I recommend to you, create your database with your own investors. Of course, not of them will invest today, but some of these investors will invest in your product in the future. So you have to create your database in the beginning and think, okay, who else can be in this database? And then step number 5, how to communicate with these guys. Of course, you have to choose your tone of voice. If you will communicate superficially, it doesn't work. You have to be unique. You have to be sparkling with sense of humor. You have to be absolutely positive. If these guys will not respond to you, it's okay. Send them letter, like choose some kind of interesting subject, like kindly reminder number 5. I send you 5 emails, you didn't respond. Probably it was like super complicated or not understandable. This is new email from me. Check this. So try to be positive. If these guys don't respond, it's okay. They're busy, but they like some kind of see like your emails, and probably these guys will not open email number 2 or number 3, but these guys will open email number 5. So you have to be positive. You have to always be like super polite and super flexible. Investors love people like this. Believe me, they have like lots of information, lots of emails, and they open these emails, and it's like nightmare, long, not interesting, boring, overwhelmed. And when it's light, absolutely understandable, believable, one paragraph, they think, oh, probably this is my guy. Let's talk to this team. It's interesting. So tone of voice, your communication, also how often you send this information. Probably you have to send this email like once a week, like not every day. And also if, for example, Anjali's channel doesn't work, send this information through LinkedIn. LinkedIn doesn't work, try to find email like through Hunter and send this email. So be persistent, and tenacity also means a lot when you communicate with these people. And why database it's important? For example, someone invests in your company, it's good, but it doesn't mean that this activities is over. You don't need to communicate with these guys. No, you have to continue communicate with these guys because this work is continuous. So what I try to say, you can say, hey guys, you know, it's a good news. We already closed 300K and we're so happy. Our next steps, this and this and this. And we will inform you in the future about our progress. So it's important when you continue this communication with your investors and these guys say, oh, it's great, this guys is amazing, or probably these guys will not respond or say something, okay, it's not interesting for us right now, or you're too small, or it's not enough numbers, or we don't understand your business model. And you have to say, okay, thank you so much, we got it, but let us this opportunity continue this communication and inform you about our progress. People love this. Just be, as I said, like more flexible and everything will be good. And then day X, when you have this presentation day when you schedule, I don't know, 5-7 calls and you have to talk to these guys, to investors. I think it will be, most of them, it will be online. So my recommendation is, of course, you have to be super prepared. Check your presentation, check your equipment, your laptop, your internet, close all these windows, talk to your friends, or if you have kids that, please, I have like my daughter, she's 14. I say like usually, please, mama will have like super important day. Like don't listen music so loud and like let me like teach, for example, or provide my master class. So you have to organize your space and of course be on time. When people waiting for you, it's bad because people like impatient and nervous. Be 5 minutes before this call, wait for your investor, and of course like pitch like a god, provide this like presentation, because even, for example, you had like 10 calls and you're exhausted and you don't have energy, like, oh my god, this is my call number 1057 and I'm so tired, but our product's so amazing. Who won't work with a person like this? No one works like with this person without energy, without enthusiasm, without I don't know, tenacity. People love work with the people full of energy. When you see these people can crush the walls. So be this person. And most important, when like you pitch, don't offer your investor with some kind of video or demo. It's bad idea because you have this chance impress this person, pitch this person, persuade this person. So do this, because when you try to like show this video usually doesn't work. You don't know what kind of internet investor have. It's always like bad idea. Try to persuade and sell this idea and deliver this information without this demo or video. And then it will be, of course, a Q&A session. Please listen your investor. Don't rush, respond. Some people interrupt and don't listen at all. Guys, please just shut up and listen because it's important. Put this question on the paper, look at this and then answer. If you don't have answer, you can say, you know, it's a great question. I didn't think about this and I don't have right now this answer. But if you give me 1-2 days, I back to you with an answer. So be honest. Don't fantasize if you don't know what to answer. If you don't have numbers, if you don't have right now this information, it's normal that it's like new angle, new perspective. You didn't think about this. Say this. It's great, but I didn't think. Let me think about this, and I will come back to you with an answer. So, and after that, it's important schedule next step. discuss, okay, for example, next step, it will be meeting with a lawyer or with another expert, and we can like go and look all our materials. Or probably investor would say, you know, it's not interesting for us, and this guy can give you very useful feedback. So don't be upset. You would say, okay, I understand. Probably give us feedback. Why? What we can improve? Because feedback sometimes can be more valuable than money and give you like new perspective, and you can make a pivot. And after that, it will be, oh my God, you know, we have in our accelerator team. They start as a team named All Wallet, and now it's All Set. And they came to our accelerator with one idea, pitch investor, and investor said, no, we don't like this at all. Guys, you have to do this, this, and this, and this. And this guy made the pivot. They was upset, of course, but they made the pivot. And now this team raised $55 million, and they're extremely successful. So what I want to say, sometimes when investors don't invest, but give you like super great feedback, this is amazing. This is awesome. Put everything in your database, collect all these answers, then analyze with your team, read it again and say, okay, so we, for example, talk with 50 investors. What these guys told us, this and this and this, what we have to do with this. Okay, probably we need to make pivot, or we need to polish our product, or probably we need to think about our user case, because we think that this user case works, but this user case doesn't work. Just think about this. Don't be upset. Just say, thank you so much. It's great. Thank you so much for your time. And think what you have to do and what you have to improve. And of course, last point, it's follow up. You have to follow up your investor. If you talk with someone, what I usually do, it doesn't matter. I receive my money or I receive some kind of advice. If someone spend time and talk to me, I always, during 2-3 hours, send follow-up, like, thank you so much for your time. It was a pleasure to speak to you. And if we discuss something, I put it on email, like 1, 2, 3, 4, 5. It's very important, because when investor or person who like spend time and talk to you, see this, it means that you persistent, it means that you like really serious person, it means that you like really want to make this connection, and it makes sense work with you. If you send me email after 1 week, you think I really want to respond to this email? You think I really want to work with you? No, I don't. But for someone who like active, like proactive, don't waste any time, and I see, okay, we just talk and I see this email, I see this follow-up, I see invitation in my mailbox, I immediately say, yes, confirm, it will be another meeting. I love this team, I love this founder. And as I said, person like people who procrastinate and send me email after 1 week or even like 3-4 days, I don't like this at all. So summarize, it's not a miracle, it's a day-to-day job, raise money, and this is continuous process. And if you choose to be CEO, you have to know that this is forever. You forever have to think about money, about your team, and about communication and work with investors, with your board, with your stakeholders. This is part of this job. It's important to structure everything, as I said. If you don't have this action plan, if you don't have this agenda, it will be very difficult. When you have this agenda and you see and you check, yes, I did this and this and this and this. I did what I can do like for today. Well done, good. Tomorrow I will continue to do this. So it's not, as I said, it's not a miracle. You will see result after 2-3 months, not immediately, because you have to earn your investors. You have to earn your reputation. People can communicate with each other and they say, you know, this founder is very good. It's probably like product, not super good product, but founder and team is very good. It is very strong. So probably we need to try. We need to give them like small money and see what happens. But as I said, if you don't have energy, if you don't have passion, if you like lazy, and if you, I don't know, send 10 emails and you think it's enough, guys, it's not enough at all. You have to crush the walls, and you have to be like super full of energy, full of optimism, energize yourself and energize your team, because your team also like, oh, we don't have money, what we have to do, probably we need to, I don't know, find another job. You have to say, guys, everything is good, I am working on it, everything will be amazing, just like do this MVP stuff, and I work with our investors. We have progress like this and this and this. We already sent like 200 emails. I had 50 calls, and I receive lots of feedbacks. So it's great. So you will see that you will have this progress. You will have lots of feedbacks. You can work with these feedbacks. And as I said, like during 2, 3, probably 4 months, you will find your investor if you will use this approach. As I said, if you will be lazy and send like 10 emails and you expect that you will receive something, this is alarms that we have to finish. It's not. Okay, guys, you see, just in time, 12 p.m. and I'm finished.
Thanks for your vibe, your energy. I really admire it. We are
Good.
taking the training for 2 hours, but it's not like that. I think everyone's happy right now. Everyone's smiling.
It's
Thank you
great,
for your
especially
sharings
if
also.
it's Saturday. It's a Saturday evening. It's great that you guys smiling. Yes,
You're
because
great.
spend all
Totally
day
great.
listen some kind of crazy people. I don't know. You're so brave. I don't know that I will be ready like listen all these like crazy people all my Saturday.
Great. So, is there any questions, guys? If you want to ask to Anna, you feel free to.
Yes, I have a question.
Dima.
Thanks, Anna, for a very inspiring and energetic talk. So you were talking about an action plan and how we sort out specific investors. For example, I have a group of those who have a specific amount of money in their fund, who invest into my part, who are located somewhere. Those are the generic data which I can check on the internet. But also there, I have other filters for my investors. For example, you told you want to find the one who will not call you in the night with dumb questions. How do I sort investors, and how do I check whether this investor will be calling me or not?
Okay, Dima, it's very easy. First of all, you have to check profile. I don't know, people communicate, lots of chats. Lots of communities, people discuss, you know, I work with this guy and this guy is a psycho, and I work with this woman or with this fund, they're amazing, help us. So you have to be curious. It's easy to check reputation, believe me. You just need to ask questions. And regarding this list of criteria, your list will be different because your product, it's a niche product, and probably you will add something. But as I said, it's very easy to check credibility when you ask people, when you ask, for example, in other startups, you always can see, for example, portfolio. Yes, all investors, most of them have portfolio. You can check, okay, on website, you have 5 teams or 10 teams that you already work. Okay, text these guys, send them email, like, guys, what's going on? Are you happy, not happy? Is it okay if like I will work with this fund or not? You know, when your behavior, like a leader's behavior, it's always amazing. When you victim, when you like, you don't know, you don't sure, probably, and people always manipulate you. You have to be super confident. And when you're confident, people want and love work with the confident people. When you don't sure and everyone can push you and say, oh, you know, probably let's talk tomorrow, after tomorrow, and you continue follow these people and say, okay, probably you don't have time. Yes, tomorrow is good for me. You can say, no, we cannot talk tomorrow because for me it doesn't work. I have my deadline. I have to raise money before October, for example. So it means that, guys, you're not in my list anymore because you cannot create decision immediately and you cannot respond in time. Communication with you like tough. So you're not in my list. So you have to think what works for you. Because right now it's lots of funds, lots of investors, lots of different type of syndicates. Don't be like, you know, like you're like just alone on this planet. It's not like this. Everywhere, lots of money. You just have to be focused. You have to know what you're looking for, how much money. We talked with you yesterday. And also you have to change, restructure your presentation, create your user case scenario and start to talk with your audience, with people who understand what's going on in your industry, with people who have this like expertise. If you talk with people like all of them, like who like from different industries who don't understand what's going on, of course it will be a problem, and you will be disappointed too, and you will be exhausted. You will don't have this energy, you know, because this people like every time like no, no, no. When you receive no and like any positive news, it's always like you're so powerless, and it's very difficult to like continue like moving on. So that
Yes,
you
I
have
feel
like
that.
super focus, like who you two can like communicate with, what kind of investors. Probably, as I said, probably it's not your investors at all. I had this experience and knock at all these doors, and people say, no, we don't like this idea, we don't like you, you don't have experience, oh, you're a woman. Like it's lots of comments like this, and I think I was frustrated. And then I think probably this is not my investors. I need to like change this strategy too. I don't want right now to talk to these guys. Probably I need to find another group of people, and this group of people will be like more suitable for me. And I did it. So this is my recommendation, and you can use it or you cannot use it, because this is for you. This is just my experience. Okay.
Thank you, Anna, for
I'm sure they
the
will use
answer.
it. Okay, so I think Zerrin has a word to say.
Thank you very much, Anna, for accepting our invitation to the session. And I already knew that it will be such a great session even before that. I just also want to, I'm sorry for making you wait a little bit, you know, things, but I was really, I think that's the great thing, that the trainer and the mentor applies what she advises. That was really great. I am also happy to say that. And you also have an accelerator program, and not everybody here knows that. Maybe you also tell a little bit about your program as well, because we just started with the session because we were already a bit late, so we didn't have much time to introduce you. So it will be really great to know that.
Okay, very briefly, yes. Accelerator Happy Farm, but right now we don't invest because we already invest all our money. We have 42 portfolio company. One of them made an exit, and we are so happy. And when I built my accelerator, it was also startup, because I thought I had this illusion that we invest money in it, and after 2-3 years we will have exit. And don't believe it doesn't work like this. It's already 10 years and we have only one exit, and we like part of our company is already dead. Okay, it's good. It's sad, but it's good. And we have right now 4 companies who are still alive and extremely successful. And honestly, I realize that even after 4 or 5 years, it will not be exit, because this process is so long. So sometimes we are so optimistic and we have this like fantasy that it will be like this, super fast and quick and smoothly, but it doesn't work like this. So as I said, we have this program, and we work with at the Happy Farm, 150 different type of experts and mentors. And we have office in San Francisco, in New York. And yes, as I said, we work with companies mostly from Central and Eastern Europe, but these companies focus on American market. So for us, it's important. And as a Happy Farm, what we're doing right now, we don't provide like full acceleration program, but we help with some kind of mentorship and master classes and strategic session. If we talk about how to grow, how to build your product, how to launch your product, and about management, because lots of companies, unfortunately, like underestimate role of management in team, and so that it's like lots of problems. But guys, it's time. It's already 12:10, so I'm happy to see you, and I wish you good luck, and be persistent, and yes, launch your projects, companies, raise your money, and yes, I wish you good luck. Thank you so much for invitation, and I will be happy to see you in the future too.
Thank you.
Bye bye.
Thank you.
So,
Bye-bye.
Zerrin, I think we are closing, right?
Yep.
Is there anyone to say something? By the way,
Thank you very much. Amazing session.
great. Okay, by the way, I'd like to thank you for showing me the understanding, guys, in the beginning. So, Zerrin, do we have take a photo? Mute atardım.
have left, and I knew that, so I already took the pictures.
Okay, great.
Great.
So
I can
see you
take
next
another
week, guys.
Ege,
Take
have
care.
video on. Just a second.
Okay.
Bye bye.
I think it's okay.
Yes, I took it as well.
Kapatıyor muyuz? Ne yaptık? Hadi kapatıyor muyuz? Fotoğraf mı çekin?
Closing, yes.
Abi ne yaptık? Niye kaldık anlamadım burada. Hadi gidelim o zaman biz de.
Haydi görüşürüz.
Arkadaşlar kendinize çok iyi bakın. Hoşça kalın. Haftaya
Ay tamam.
görüşürüz. Bitti mi?